What's up, guys? Nuance Bro checking in, and today we're going to be talking about a piece from ProPublica that shows how billionaire Peter Thiel turned less than $2,000 in 1999 into $5 billion tax-free. Now, if you don't know who Peter Thiel is, well, he's a very well-known Silicon Valley venture capitalist. He was involved as one of the founders of PayPal, along with others like Elon Musk. That's where he made a large portion of his fortune, early fortune that is. He was also known as the first major investor in Facebook back in the day, and he also co-founded other companies like Palantir. Now, ProPublica, which is a left-leaning publication, recently came across a trove of secret IRS documents about the most wealthy individuals in America and their tax returns, etc. And one of the things they found was on Peter Thiel and what's called a Roth IRA, and how from this Roth IRA, he turned less than $2,000 into $5 billion in about 20 years. So what is a Roth IRA? How does it work? We'll get into that. Let's read the article. So we can see here, they got this nice little animation here of Peter Thiel, and it says, Lord of the Roths, how tech mogul Peter Thiel turned a retirement account for the middle class into a $5 billion tax-free piggy bank. So here we can see the main part of the article starts out talking about how 1 in 4 working age Americans has nothing saved for retirement, a 2020 Federal Reserve study found. And this issue of savings in America has always been an issue. So politicians try to create these sort of tax incentive programs to help Americans save. One of which was the traditional IRA. Now, traditional IRAs have existed since the 1970s, but by the 1990s, politicians on both sides of the aisle were fretting over the declining savings rates in the US. And it was against this backdrop that an idea Senator Roth had been pushing for years finally found its moment. And here's where we get the explanation of what an IRA is, individual retirement account, versus a Roth IRA. Run-of-the-mill retirement plans, a traditional IRA or 401k for instance, defer taxes to a later date. The money that people put into their accounts is deducted from their income, so they aren't taxed up front, nor are the dividends, interest, or gains on investments along the way. But when retirees withdraw money, they have to pay income tax on it. So think of someone who made $100,000 in the year 2020. In that year, the max contribution you could make to a 401k, for example, generally speaking, was about $19,500. So you take your income of $100,000, you subtract $19,500, and that's your tax burden because you're contributing that to your tax deferred account. And then when you withdraw money from that account, when you retire, you pay whatever the tax rate is at that time for your income bracket. The idea being that because you'll probably be in a lower income bracket during retirement, your tax rate will probably be lower. A Roth, by contrast, eliminates tax liability rather than deferring it. People who open a Roth don't get the tax break on the money they initially put in, but once they deposit that money, their investments grow tax-free forever, and retirees don't pay a penny of taxes on withdrawals. Even better, unlike a traditional IRA, the Roth doesn't require retirees to deplete the account as they age. So take that previous example of $100,000 someone made in income in the year 2020. They're not getting any sort of deduction on that by contributing to this retirement account. So the max contribution you could make in 2020 to a Roth IRA was $6,000. You're not getting any deduction on your income when you contribute to that account, but all that money in that account now gets to grow tax-free. That entire $6,000, if it turned into $1 billion, you pay zero tax on those gains. The law creating the Roth IRA passed in 1997 with overwhelming bipartisan support. One day in early 1999, a deputy of Thiel's at the company that would become PayPal walked into the San Francisco office of Pensco Pension Services. It could have been an uneventful appointment. Instead, it changed Thiel's life. Thiel, then in his early 30s, carried himself like a contrarian philosopher king. A few years earlier, he had co-authored a Jeremiad against multiculturalism that accused the administration of then-President Bill Clinton of waging class warfare. Quote, taxing the rich seems to have become an end in itself, he and his co-author wrote. By the way, shout out to David Sachs. He's the co-author of the book that they're mentioning. And the book is called The Diversity Myth, Multiculturalism, and Political Intolerance on Campus. And they wrote this in the late 90s. Anyways, back to the article. In an interview with ProPublica, Pensco founder Tom Anderson recalled how Thiel and other PayPal executives had wanted to pull startup shares of the company into traditional IRAs. Anderson dangled something sweeter. Quote, "I said, if you really think this is going to be big, you might want to consider this new Roth. If the investment ballooned," he remembered saying, "you're not going to pay tax on it when you take it out. It's a no-brainer." So again, remember, the Roth was established in 97. This conversation was happening in 99. They immediately grasped that, Anderson said, and they did it. Thiel used his new Roth IRA to purchase shares of his startup. In 1999, single taxpayers were only allowed to contribute to a Roth if they made less than $110,000. Like many startups, PayPal offered its top executives low initial salaries and large stock grants. Thiel's income that year was $73,263, the IRS records show. Thiel also had an advantage over most Americans with IRAs, who typically use them to purchase publicly traded stocks, bonds, mutual funds, and certificates of deposit. Since Thiel used his Roth to buy shares of a private company, the value wasn't set on a public exchange. Now, this is really important to understand, and we're going to go over a graphic that better explains how this is done so you can just visualize it better, but let's keep reading. While SEC filings describing that time don't mention Thiel's Roth, they show that he bought his first slice of the company in January 1999. Thiel paid 0.001 per share, yes, just a tenth of a penny, for 1.7 million shares. At that price, he was able to buy a large stake for just $1,700. In 1999, $2,000 was the maximum amount you could put into a Roth in a year. So basically, PayPal, back when it was a private company in its early days, Thiel bought 1.7 million shares, valued at a tenth of a penny each share, for $1,700. Let's take a look at an illustration to better understand what's going on here. So here's a hypothetical example you can see here, illustrated earlier in the article. Let's say you have a Roth IRA worth $1,000. You contribute $1,000 to this Roth IRA. Then in a scenario that only a handful of people have access to, you use that money to buy 1 million shares in a new startup company for just a fraction of a penny per share. So you buy 1 million shares. At a tenth of a penny, that's $1,000. A few years later, that company goes public and the value of each share rises to $50. So congratulations, you IPO'd. Now your Roth IRA is worth $50 million. Normally, when you sell those shares, you would owe the IRS 20% of your gains. But since this all happened inside a Roth IRA, you don't pay any taxes. Now you have a bunch of capital. You got $50 million, and now you can invest that however you want again. And then when those companies go public or their stock increases in value, your Roth IRA keeps growing. So I think you guys have a decent idea of how this works. And as long as you wait to cash out until you're 59 and a half years old, that money will never be taxed. Now you might be asking yourself, well, this Roth IRA was designed for middle-class people who typically don't have access to these private shares in these private companies in the early stages of them, being startups and growing and all that stuff. And how could he value a company like PayPal, even in 1999, where he could buy shares at a tenth of a penny and get 1.7 million shares for $1,700? How does that valuation make sense? Wouldn't that be against the law? Isn't there some law against that? Well, there kind of is. Thiel's unusual stock purchase risked running afoul of rules designed to prevent IRAs from becoming illegal tax shelters. Investors aren't allowed to buy assets for less than their true value through an IRA. The practice is sometimes known as stuffing because it gets around the strict limits imposed by Congress on how much money can be put in a Roth. And then there's details about how Thiel's founder shares were among those the company sold to employees at below fair value. Tax law professors comment on it, saying it appears indefensible. A Seattle tax attorney who specializes in IRAs was interviewed and basically said he advises top executives against purchasing founders' shares with a Roth to avoid accusations by the IRS that they got a special deal and undervalued the shares. Quote, "I would be concerned about the fact that you can't support the valuation number as being reasonable," he said. At the time Thiel bought his founder shares, his own hedge fund had already loaned the new startup $100,000, California and SEC records show. And then it starts talking about how millions started pouring into the company just a few months after, and how the dot-com bubble was in full swing. But when it came time for Pensko, the custodian of Thiel's Roth, to report the value of the account to the IRS at the close of 1999, none of the investor enthusiasm was apparent. Pensko told the IRS that Thiel's Roth was worth just $1,664 at the end of 1999 tax records show. After 1999, Thiel would never again contribute money to his Roth tax records show. He didn't need to. In just a year's time, the value of his Roth jumped from $1,664 to $3.8 million, a 227,490% increase. So whereas normal people continue making contributions to their Roth year by year, Thiel just put in that initial $1,700 investment, and from that, he turned it into $5 billion, never adding another penny to his Roth. Then in 2002, eBay purchased PayPal. That same year, Thiel sold the shares still inside his Roth. His financial assistant later told New Zealand officials the tax-free proceeds poured into his account. By the end of 2002, Thiel's Roth was worth $28.5 million, tax records show. If he had held his shares outside of the Roth in a normal investment account, Thiel would have owed the IRS 20% of his gains and owed another 9% to California tax authorities. Because the shares were in a Roth, he had no tax bill when he sold them, saving him millions. So now he had tens of millions of dollars to play around with, and in 2003, he co-founded the company Palantir, which, full disclosure, I am an investor in, a data analytics company helped by an early investment from a CIA-backed venture fund. Thiel used his Roth to buy shares of Palantir when it was still a private company, years before it was listed on the New York Stock Exchange, according to a ProPublica analysis of tax records, an SEC filing, and shareholder records included in a civil suit. Over the years, Palantir has won federal contracts from the military to hunt terrorists and from U.S. Immigration and Customs Enforcement to find undocumented immigrants. And here's probably the most ironic of them all. Even the IRS has a $99 million contract with Palantir to comb through data to identify tax cheats. Amazing. Then in 2004, Thiel met Mark Zuckerberg, a Harvard undergraduate who had come to Silicon Valley for the summer to work on growing the company that would become Facebook. Thiel invested $500,000, Facebook's first large outside infusion of cash. Those Facebook shares ended up where else? In Thiel's Roth IRA, an attorney for Facebook later disclosed in a letter filed in federal court. That ensured that Thiel wouldn't owe taxes on his early investment in the company. By the end of 2008, the Roth was worth $870 million. Now, here's where it talks about how the Roth IRA, again, originally developed for the middle class, then kind of shifted. Because up to this point, Thiel was one of the few Americans who had managed to amass prodigious Roth accounts. Among the others were at least 3 additional PayPal alums who eventually built Roths worth more than $80 million each, according to tax records and SEC filings. Even so, the existing income limits managed to keep most of the super rich out. Then in the latter years of the George W. Bush administration, Congress took a wrecking ball to those defenses, and the wealthy stormed in. The change centered on an unsexy-sounding maneuver known as a Roth conversion. It works like this. If you have money in a traditional IRA, you can transform it into a Roth as long as you pay one-time income tax on the money. By converting the account to a Roth, no additional income taxes are ever due. Conversions had existed since the Roth's conception, but they had been restricted to Americans making below $100,000 per year. So this is what's known as a backdoor Roth, because if you make above the income threshold, you're not allowed to start and contribute to a Roth IRA, but you can take an existing IRA and convert it to a Roth now after the Bush administration came in and changed this in 2010. The new backdoor into the Roth opened in 2010 and set off a frenzy of conversions among hedge fund managers, industrialists, and heirs, the tax records reviewed by ProPublica show. Weschler, the Berkshire Hathaway executive, amassed a giant traditional IRA in his years as a private equity partner and hedge fund manager. He converted a whopping $130 million. His boss, Warren Buffett, converted $11.6 million after paying the one-time tax. Both men saw their Roth accounts soar. He added he paid more than $28 million in federal taxes to convert his account to a Roth. This is Weschler. Some of the wealthy managed to avoid even that one-time tax bill. And this is fantastic because I really love the hypocrisy involved in this point. 3 members of the Ibrahimi family, whose patriarch made a fortune at the software firm Quark, collectively converted $65 million into Roths in 2010 and 2011. Farhad Ibrahimi, one of the heirs of the fortune, has supported left-wing causes and became known for walking around the Occupy Boston protest in 2011 wearing a hand-lettered t-shirt that declared he was a member of the 1% and said, "Tax me, I'm good for it." Kind of. He converted $19.4 million into a Roth, which would have triggered $6.8 million in income tax, but thanks to losses generated by other investments, he wiped out the tax bill on the conversion. Ibrahimi declined to comment. Isn't that amazing? This guy who went to the Occupy Wall Street protest, he was like, "I'm the 1%, tax me more. I want to get taxed more. I support you guys." He refused to comment on this story because he got exposed. In secret, he does things that are very contrary to what he says publicly. Now, here's something interesting. For 5 years, starting in 2010, Peter Thiel dipped into his Roth for at least $254 million. That is almost unheard of among the wealthy, tax advisors say, because it shrinks the pot of money that can be invested tax-free. Because Thiel was still in his 40s, he was too young to pull the money from a Roth without paying income tax, plus a 10% penalty on these withdrawals. During the life of his Roth, Thiel also has made money outside of it. He took in an additional $687 million of income from 1999 to 2018, largely from gains on investments, tax records show. All told, over that period, he paid $206 million in federal taxes, including the taxes on early Roth withdrawals. Now, you might be saying, okay, I think if someone turned $1,700, close to $5 billion in a 20-year period, and he did this by taking these private shares that were almost certainly below fair market value, and he just stuffed that into his Roth one time in 1999, you'd think, well, if the IRS audited this guy, they would say, "Oh my God, this is crazy. This is illegal. You owe us, who knows, billions of dollars in taxes potentially." But here's the interesting thing. In 2011, Thiel caught the attention of the IRS. The agency launched an audit, tax records show. The records don't spell out what the IRS was looking at or if it involved Thiel's Roth. Whatever the case, the audit was closed years later and Thiel didn't owe any more in taxes, tax records show. So they look at his records and they do an audit and they don't even find an extra dollar that he owes in taxes. That's amazing. Now, in subsequent years, you've had senators like Ron Wyden of Oregon asking the investigative arm of Congress to look into this matter. And in a landmark report issued in 2014, the GAO sounded the alarm, finding the mega IRAs stood in contrast to Congress's aim. IRS officials told investigators that the federal government was losing more and more money to IRA abuses. The GAO investigations flagged aggressive valuation tactics by private equity. And while it didn't mention Thiel or his PayPal co-founders, the report laid out how startup founders' shares could be used to render IRA contribution limits irrelevant. Individuals can manipulate contribution limits by grossly undervaluing investments at the time the individual uses an IRA to purchase them, the congressional investigators wrote. The report estimated that as of 2011, there were around 300 taxpayers with IRAs worth more than $25 million. That detail reverberated around the media and Capitol Hill. Few knew that most of those accounts were minuscule compared to Thiel's, which that year was valued at nearly $1.6 billion. And I'd have to imagine that 300 number is probably in the multiple thousands now. So Senator Ron Wyden tried to propose a solution. In 2016, he released a plan that would require owners of Roth IRAs worth more than $5 million to take money out of the accounts. Amid howls of protests from the retirement industry and a Senate and House controlled by Republicans, Wyden's proposal went nowhere. The IRS, meanwhile, was floundering in its efforts to police retirement accounts. At one point, the agency recommended Congress prohibit IRA accounts from buying investments that aren't traded on a public market, such as founder shares. That went nowhere too. Instead, Congress began slashing the IRS's budget, kneecapping the agency for more than a decade. Now, when it comes to my opinion on this, I have to say I think Ron Wyden's initial proposal was kind of stupid, limiting the at $5 million or whatever. I think the IRS's proposal made a lot more sense because if this is meant for middle-class Americans, and that's why you have that income cap on there, then limiting it to shares that most middle-class Americans can actually buy, which is public market shares that are listed on a stock exchange, that makes a lot more sense. And maybe prohibiting founder shares and private equity shares, for example, potentially. I'm not saying I necessarily support that, but I think that makes more sense if you're trying to stop potential IRA abuses. By 2019, Thiel's holdings had grown so vast and diverse that his $5 billion was spread across 96 sub-accounts inside his Roth. And here they try to work some extrapolation. Assuming a modest 6% annual return and no withdrawals, his tax-free golden egg could be worth about $263 billion in 2087 when Thiel plans to celebrate his 120th birthday, which that's kind of a joke because Peter Thiel invests in anti-aging companies and he wants to live to be 120 years old. That's larger than the current gross domestic product of New Zealand, his adopted homeland. Now, here's the thing. Whether you agree with what Peter Thiel did, if you think it's moral, immoral, if you think he was smart, if you think it was corrupt, if you think it was legal, illegal, whatever, I think the lesson, at least, that all of us can understand is the benefit of a Roth IRA for normal, everyday people. I mean, look at this graph. Even though Peter Thiel's Roth IRA worth is insane compared to if you just invested in the S&P 500 and made your max contributions every year, check this out. In 1999, you start out with $2,400. In 20 years, that turns into over $250,000. That's a pretty fantastic return on investment. And that's only if you invest in a sort of passive S&P 500 fund. If you're smart about investing, you understand investing, maybe you can get even better returns. For example, in the last few years, I've been getting way better returns than just the measly 6 or 7% annual return you can expect from an S&P 500 over the long term. And this is where understanding the effects of compound interest can really come into effect. And why it's so important, I think, to start a Roth IRA as early as possible. So let's take a look at a compound interest calculator, which you can see here on investor.org. Let's start with the maximum contribution you can make in the year 2021 for a Roth IRA, which is $6,000. And we're going to try to contribute the maximum every year, which is a monthly contribution of $500. And let's say you're starting this at 20 years old. Now, the retirement age for a Roth IRA is 59 and a half years old. We're just going to call it 60 to make it an even 40 years. And again, a conservative estimate on return for an S&P 500 index fund is about 7% a year or so. So let's put in 7% with an interest variance range of about 2%, and we'll compound that annually. So you take that initial $6,000 investment, put in $6,000 each year after that. Of course, contribution limits will probably raise in subsequent years so you can contribute even more. If you maintain a measly 7% return year over year, compound interest, you turn that $6,000 you initially invested plus the additional money you invest year after year above that, you turn that into $1.3 million just about in 40 years. And all the gains from that are tax-free. Now, let's say you do a little bit better. Let's say you turn that 7%. Instead, you turn that into 10%. Now you just turned it into $3 million. So should Congress change the laws around Roth IRAs so that the super rich can't abuse the tax system and get away with tax-free wealth? Probably. They should probably maybe change it to only public market shares or something like that. I don't know. Maybe. I'm not saying 100% this is the case, but that's probably what they should do. But the real lesson should be, you should probably get a Roth IRA. And if you guys want to get involved and start a Roth IRA yourself, well, I have a referral link down in the description below for Webull, where you can start a Roth IRA. If you deposit $100 within the first 30 days, you get free stocks. How could you say no to free stocks? So use the description down in the link, the description below. Use the link in the description below. Get your free stocks, deposit $100, start your Roth IRA. Again, not financial advice, just my opinion. I have a Roth IRA, and I intend to try to maximize my contribution every year if I can. And yeah, that's going to be it for today, guys. Don't forget to like, comment, and subscribe. Social media links are in the description box below, as well as merch. Support us at nuancebro.com/join, and I will see you next time, bro.